Hi, I'm Drane and welcome to my January 2021 market wrap-up. And what an interesting time we are in real estate. Housing values continued to rise through the first month of 2021, with CoreLogic's National Home Value Index up 0.9% over the month. The January movement takes Australian home values to a fresh record high. Housing values have surpassed pre-COVID levels by 1%, and the index is 0.7% higher than the previous September 2017 peak. Continuing a trend that became evident early in the pandemic, regional housing values rose at more than twice the pace of the capital city markets. CoreLogic's combined regionals index was up 1.6% over the month, while capital city values were 0.7% higher. Since the onset of COVID-19 in March of 2020, regional housing values have surged 6.5% higher, while capital city housing values are down 0.2% over the same time frame. The largest states are seeing regional home values rising at more than 3 times the pace of their capital city counterparts. Home values across regional Victoria and regional New South Wales rose 1.6% and 1.5% respectively in January, compared with 0.4% increase in home values across Melbourne and Sydney. According to CoreLogic's research director, Tim Lawless, the divergence between metro and regional housing demand in New South Wales and Victoria is more substantial than in other states. Internal migration data shows more people are leaving Sydney and Melbourne for regional areas, resulting in a transition of activity from the metro regions to the outer fringe and to regional markets. This demographic trend is further compounded by the demand shock of stalled overseas migration. As Melbourne and Sydney historically receive the vast majority of overseas migrants, these metro areas have been the hardest hit by this, what we call, demand shock. Better housing affordability, an opportunity for a lifestyle upgrade, and lower density housing options are other factors that might be contributing to this trend, along with the newfound popularity of remote working arrangements. Another broad trend that is becoming increasingly evident is the outperformance of houses over units. At a national level, house values have risen by 3.5% over the past 6 months, while unit values are unchanged. More recently, the past 3 months has seen every capital city record a stronger result for houses over units. Demand for units has diminished through COVID-19 amidst record low levels of investor participation and changing living preferences. At the same time, supply levels are heightened in some precincts. While demand and supply remain imbalanced, we're likely to see units continue to underperform relative to detached housing markets. And we're seeing that here in the hills. The rise in housing values is occurring against a backdrop of low advertised supply and rising buyer activity. Inventory levels started 2021 in a tight position. The number of fresh listings added to the market nationally over the 4 weeks ending in January 24th was 3.3% lower than the same period last year and 13.3% below the 5-year average. Although fresh stock being added to the market is close to the same levels a year ago, total advertised inventory started the year around record lows. Nationally, total listing numbers, which include new listings plus relisted properties, were 27.8% lower than this time last year, tracking 29.3% below the 5-year average. Another factor impacting available housing supply has been a strong rate of absorption from rising home buyer activity, especially in the detached housing space. The number of national home sales over the past 3 months was 23.9% higher than the equivalent 3-month period from a year ago. The volume of regional home sales was estimated to be 26.8% higher than a year ago, while capital city sales were up 22.1%. With housing activity continuing to rise above average levels while listing numbers remain well below average, the natural consequence is upward pressure on housing prices. Advertised supply levels are low while demand is strong. This is a seller's market. but for some reason we are still seeing below normal vendor numbers across most markets. With sentiment rising and selling conditions favouring the vendor, it is reasonable to expect new listing numbers will rise as the year progresses. This may help to temper housing market conditions. Some early indicators suggest that new listing numbers are set to outpace levels from a year ago. Real estate agent activity across CoreLogic's RP data platform is up 6.5% over the first 28 days of January, compared with the same period in 2020. A lift in real estate agent activity typically leads to a rise in new listing numbers with a lag of a few weeks. We are expecting to see new advertised stock levels rising substantially through early February, well above last year's levels at least. However, buying activity is also ramping up, with a number of mortgage-related valuations already 27% higher than a year ago, and this is across CoreLogic's Valex valuation platform. At the moment, despite our expectation of a lift in new listing numbers, buy demand is still outpacing new stock additions. If this trend persists, the rapid rate of absorption is likely to keep overall stock levels low, resulting in further upwards pressure on housing prices. Overall, the January results from CoreLogic show the housing market has started the year on a firm footing, setting the scene for further price rises throughout the year. Many of the housing market headwinds have dissipated as the Australian economic recovery consistently outperforms forecasts. Labour markets are continuing to improve even though JobKeeper is winding down. Mortgage repayment deferrals have reduced to just 2.4% of all mortgages, after comprising around 11% in May of last year. And buyer activity is well above average, even though overseas migration has virtually stopped. Low interest rates have been a key factor in supporting the housing market recovery. Mortgage rates are likely to remain at record lows for the foreseeable future, with little chance interest rates could rise this year. This is because inflation and unemployment are still a long way from reaching the RBA's objectives of full employment and returning the annual inflation rate to the target range of between 2 and 3%. The most significant risk to housing markets remains further outbreaks of the COVID-19 virus. The recent series of outbreaks and subsequent border closures and restrictions through late December and January had an immediate negative impact on consumer sentiment. As we know from the Melbourne example, a sustained period of restrictions focused on containing the virus would likely see economic activity, including home buying and selling, temporarily stalled. This could result in renewed downward pressure on housing prices. Here at Harcourt Sills Living, we are seeing numbers at open homes and bidders at auction exceed anything I have ever seen before in 18 years of real estate. This demand is pushing prices up, and we continue to see sale prices way above our expectations. In my opinion, a well-run auction campaign is the only way to capitalise on strong demand and a lack of supply. In other words, let the market set the value of your home, not the agent. That's it for me for January 2021. I'm Drane from Harcourt Sills Living. I'll see you for the February 2021 market wrap-up.